Welcome to Accounting with Our Bare Hands, a series of short videos on the mechanics of cost accounting. This is a continuation of standard costing. We're on our fourth video, variable overhead variances. In this video, we will be continuing with the example of the essay grading service that we discussed last time. According to our budget, we thought that our business would grade 100,000 pages at a labor cost of $1 million using 50,000 labor hours. Our focus now is on variable overhead. Now, our variable overhead driver is direct labor hours. According to our budget, we think we will incur $2 per direct labor hour. We actually are incurring only $1. Okay, so some good news for our essay grading services. I guess we'll get a good grade at this company. So now, there are really two things going on when we think about variable overhead, and that good news is not the only news. We have some bad news too. Remember that labor hours are our driver. So we used, as we saw in the last video, our business used 60,000 pages where, it should have taken only a half an hour a page, and so that's 110,000 pages. That should have been 55,000 hours. So although our cost per hour is a little lower than the budget said it would be, the number of hours driving variable overhead is a little bit higher. So we're going to see a favorable variance because our predetermined overhead rate came in a little high, right? Actuals were lower than $2 per labor hour. But we're going to have an unfavorable variance because we used too much of the driver and drove too much variable overhead. We're going to analyze this with our variance crown. As we had last time, the left side of the crown is the amount that we incurred, and the right side is the amount that we applied. Okay? In the middle, we are going to create a split point so that we can separate the difference between incurred and applied into the two variances, one reflecting that we used too many hours of labor, and one reflecting that our variable overhead per hour was lower than expected. So how much, let's start with our incurred amount, and how much here did we incur? Well, we're told that we had 60,000 actual direct labor hours, and that our variable overhead came out to $1 an hour. So that's going to be $60,000 of overhead incurred. How much did we apply? Well, the important thing to remember is that standard costing systems apply costs at standard costs, right? So we're going to say, okay, we graded 110,000 pages, and each one should have taken half an hour, so that's 55,000 hours that we should have had, and each of those should have cost us $2 in variable overhead. So 110,000 times a half times 2 just gets us back to our $110,000. So we've got $50,000 of over-applied overhead. We applied 110. We only incurred 60. Now, back in the old days when we did normal costing, we took this difference here and we just made a single adjustment to cost of goods sold, but that's not going to be good enough for us if we really want a good report of why costs are deviating from what they should be. Then we're going to want to split this into a price amount and a quantity amount. So the way to think about it is that the incurred amount here is the actual price, or I'll do it, I'll say actual quantity times the actual price. Okay? The applied amount is the standard quantity per units produced times the standard price. And in the middle, the split point, we're going to use the actual quantity times the standard price. And again, as we saw before, that's over here. We're going to have the actual quantity times the actual price minus standard price. So the part we're capturing, this is called the variable overhead spending variance. And it's really telling us whether our standard price here is our predetermined variable overhead rate. So it's really just telling us whether the actual price was higher or lower than our predetermined variable overhead rate. And the difference between these two is the standard price times the actual quantity minus the standard quantity per units produced. And this is the variable overhead efficiency variance that gets at the question, did we use our driver as efficiently as we could have? Okay, so our actual quantity here is 60,000 hours, and the standard price is the $2 per hour that we budgeted for. So here we have 120,000. And so now what you can see is that we actually have, by saving that dollar for each of 60,000 hours, we actually have a $60,000 favorable spending variance. But by using 5,000 hours more than we should have, 60,000 instead of 55, and each of those getting an application of $2, we have here, wait, hold on, did I, give me a moment here, so that's 60, 120, yeah, 100, right, the 120,000 minus the 110 gives us a $10,000 unfavorable variable overhead efficiency variance. Okay? Let's look now at the debits and the credits in the Queen's Cross. Let's just assume that the resource we're using up for variable overhead is cash. We incurred $60,000. And we put that into our overhead account over the course of the period. We apply $110,000. That comes out of our manufacturing overhead account and goes into work in process. And now, when we talk about use rate, again, we used to just make a single adjustment. We'd have a $50,000 debit to manufacturing overhead here. But instead, we're going to break this into the two parts, our two variances that we have here. So we are going to make, we have here a $60,000 credit, which we're going to put into our variable overhead spending variance of 60,000. So we have a credit. Oh, sorry. That's going to be a debit because we are going to credit our spending variance. This is good news. It's expense reducing on our income statement. And then we have a credit of 10,000, which is going to be balanced by our variable overhead efficiency variance of $10,000. An unfavorable variance because we used 60,000 hours where 55,000 should have done it. And again, this is $60,000 we saved by cutting our variable overhead per hour to $1 from the budgeted $2. So again, this really is just coming back to something we did in a very early video on allocating overhead. And remember, the last step in dealing with manufacturing overhead is to make sure our manufacturing overhead account is zeroed out, right? So here, now you can see we have debits of 120 and credits of 120, so it's zeroed out. And instead of just having a single adjustment to cost of goods sold, we've set up two different accounts that tell us the two different reasons that variable overhead was, in this case, over-applied. Ultimately, we will close these accounts into cost of goods sold, and you can see that in addition to our unfavorable rate variances that we saw in the previous video, we now have a $10,000 cost of goods sold increasing adjustment for our unfavorable efficiency variance and a cost of goods sold decreasing adjustment of $60,000 for our favorable spending variance. Come back for our last video on the fixed overhead variances. See you there. Bye-bye.